Hey everybody, welcome to you. It's Wednesday. That means it's time for managing an options portfolio. My name is Brent Moores, and want to talk to you a little bit about vertical spreads. I want to talk to you about some of the differences between long verticals and short verticals, when you may consider one versus the other. And then I want to go to managing some existing paper trades that we have in our account to just familiarize yourself with managing various types of option trades. So we're going to do that next. Glad to see you here. See some familiar names in the chat. And if you're watching on a recording, that's great too. We're just glad you're here. So let me go through some disclosures here in just one sec. But let me just remind you, you can follow me on X at BrentMooreCS. And I think Ben's going to be joining me in the chat here if I'm not mistaken. And you can make sure you follow Ben at BenWatsonCS as well. But glad you're here. Hey, options do carry a high level of risk, though, and are not suitable for all investors. And the information here is for general informational purposes only. It's not an individual recommendation of any security, chart pattern, or investment strategy. And the paper money software application is for educational purposes only. For the sake of simplicity, I may not factor in commissions into all these trades here that we're going to be looking at. So don't just remember that is a factor to consider. And all investing involves risk, including the potential loss of principal. And past performance of any security or strategy does not guarantee future results or success. Yeah, there's Ben in the chat. Ben, the webcast immediately preceding this one is trading index options. Make sure you check that out each week too. As well as, are you interested in futures? Well, I don't talk about futures in this class, but Ben does on Tuesdays, 9:30 Eastern time. Check that out. All right, let's head on over to the Thinkorswim platform. This is a Thinkorswim desktop software, and market is up marginally right now. But I want to pull up a stock. And, of course, it's earnings season, so you're going to see a lot of stocks that are about to come out with earnings. Meta and Microsoft, after the bell today, earnings. We've already had earnings on Google or Alphabet, and the stock has been trending up. And you may be considering, hey, I'm interested in doing a bullish trade on this. And, of course, there's a whole variety of different types of trades you can potentially do. And, there's one possibility is you could consider vertical spreads. And there's long verticals and there's short verticals. And bullish long verticals are long call verticals, and bullish put verticals are short put verticals. So when would you use one versus the other? Well, let me tell you one reason you may not do that. And that is, well, let me show you here. Let's do an example on this. And I'm just going to go to the trade tab. And I'm going to go here, and I'm just going to go out 30 days on this. And let's look at a long, I'm just going to pick a strike. I'm going to go, let's just do a 190-200 long call vertical here. If I click on the ask price, and we look to buy that 190 call, and I click on the bid price, control click on that bid price, and look to sell that, and I'm just going to click on confirm and send. And I'm just going to look, let's just look at these numbers here on this long call vertical spread. Okay, max profit, $420. Okay, max loss, $580, and my break even is 195.80. 195.80. I'm writing that down because what I'm going to do now is I'm going to go here, and instead of this long call vertical, let's use the exact same strikes with the short put vertical. What are we going to see here on this? So with a short put vertical, I'm going to sell the 200. I'm going to use the same strikes, the 190, 200. I'm going to sell the 200, and I'm going to buy the 190. That one I'm going to buy. I'm going to hold down my control key. And let's click on confirm and send. And let's look at my max profit and my max loss. Let me just jot that down real quick. $417, max loss, $583, and break-even price, $195.83. Okay. Do you see what just happened there? Um, just for those of you, if you didn't see that, let me just kind of write these out for you. And I'm going to answer your question there, John. That's a good question here. But I want to compare the two, long call vertical and short put vertical. Long call vertical are max gain, these are theoretical max gain, was $420. Short put vertical, my max gain was $417. Okay. Essentially the same thing. Okay. Max loss. Okay. It was 580 and 583. Essentially the same. Break even points on those, it was 195. Forgive my kind of chicken scratchy writing here. It's a little harder with this cursor. I don't have the neatest penmanship in the world in the first place, but it is a little harder on this screen here. 195.83. Okay. So in other words, if you're considering long call verticals or short put verticals, or similarly, if I were to do long put verticals and short call verticals, we'd see the same result. The reason to choose one versus the other is not changing the max gain, max loss, or break-even point. Okay, that is not the case. And I didn't know exactly what these numbers were going to be. They bounce around and whatnot. It doesn't matter whether we're going in the money more or out of the money more. If you pick the same strike prices, they're going to essentially be the same thing. Okay, so let me tell you like a little bit more as we look at this. Okay, let me go as to a reason why we may do that. And I don't want, hold on, close header. I don't want header and footer. Okay, let's do this. Let's look at the same scenario and let's consider where these are in relationship to the current stock. This current stock was like 197, but it doesn't matter. But let's just say 197 is the current stock price. And in the case of our long call vertical, we have a 190 in this example call, long call. I'll just put a +1 for the long call, and a 200 short call. And I want to ask you this. Is the 190 call in the money or out of the money? Okay. Is the 190 call in the money or out of the money? It's in the money. Is the 200 call in the money or out of the money? It's out of the money. Okay. The stock price is beneath. In the scenario we did, the stock price is beneath the strike price. So it's out of the money in the case of a call. In the case of a put, let's do the same thing. We got a 190 put, and that's going to be a long put. So I'm going to go +1 here. And we've got a 200 put, which in this case is a short put, -1, we'll put there for that. In the money or out of the money? Okay. The 190 put, it is out of the money. Okay. Out of the money. And the 200 put, 200 short put is in the money. Okay. So in that case, there's a little bit of a problem here. The short options, okay, and I don't know that I read this on the disclosure today, but on the disclosures often we'll read, and we remind you often in this class, I remind you most weeks in this class, short options can be assigned early, which is the scenario where we're more likely to get assigned early if a short option is in the money. So if we do this short put vertical in this scenario, this is a short put vertical, okay? If we do this short put vertical versus the long call vertical, given the strikes that we just picked, where are we more subject to early assignment? That short put vertical. That is a big reason why, given this scenario, why we may elect to do a long call vertical as to a short put vertical. Now let's do one more scenario here. I'm going to go to the 180 strike. Okay, let's say we do a 180 strike, and we're going to make that a long call, and we're going to do a 190 strike. Remember, the stock right now is 197. I'll just jot that right down here. Stock right now is at 197. And I'm going to do a 190 short call. So in this case, what do we got? We got two contracts that are in the money, okay, if we were to do this. Now, there may be reasons we picked the different strikes, and I'll go through that in just a minute. Whereas if we were to do those same strikes with put contracts, okay, 190, and we'll kind of summarize our conclusions here in just a sec, and a 190 short put, these are both out of the money. If the strike prices are below the current stock price, those are out of the money contracts. So in this scenario, okay, in this scenario, these are staying out of the money. There's less odds, less chance of early assignment in this case. So what we typically try and do is we try and stick with the ones that have less chance of early assignment here. And so that's a big reason. Here's another thing. Typically, out of the money contracts are going to have tighter bid-ask spreads than in the money contracts. Now, I can't guarantee it, but in general, you're probably going to find that's the case. So we're going to try and stick with out of the money contracts here on these. Now, does that mean we should always do like this short put vertical? No, that's not the case, because there's other considerations. Other considerations include reward to risk ratios, and probabilities. When you're looking at a trade, okay, it doesn't even matter whether it's a vertical or not. I want you to consider your reward to risk ratio and your probability. But in this case, just let's look at our reward to risk ratio and probabilities. Let's start with this one over here, okay? It's a short put vertical out of the money, or a long call vertical that's all the way in the money. Now we're going to kind of go to the out of the money contracts for the reasons I already stated beforehand. Higher probability trade, we're going to emphasize one or the other typically. Okay, are we going to more emphasize the probability of the trade or the reward to risk ratio of the trade? If the stock's at 197, all we want is that we want it to stay above our short strike here. Okay, in other words, it's already in a winning position, so to speak. If the stock were to stay right where it's at and go to expiration, that's great. This is a higher probability trade. Okay, this is a higher probability trade. So when we are looking for higher probability trades, the bottom line is, okay, when you're looking for higher probability trades, the bottom line is we're going to tend to go with short verticals. Out of the money short verticals. Now, the consequence of going higher probability, is we're typically going to have a lower reward to risk ratio, a little bit worse, okay? So there's pros and cons there on this. Okay? There's pros and cons. And as Kelly said in the chat, it expires worthless above. Yeah, if this stock stays above our upper strike, 190, it expires worthless above us. What if we were instead to do this long call vertical over here, the one I've already suggested maybe we're not going to do? Well, these contracts are in the money, actually, okay? So these would both be automatically assigned at expiration, assuming the stock, they're both in the money, okay? So there's that. There's that. Now, let's say instead of looking for the higher probability trade, we said, I want a higher reward to risk trade. I want, because, when we do these higher probability trades and we look at those reward to risk, a lot of times the reward to risk is like 30%, 35%, maybe 40%. But in other scenarios, I want to emphasize my reward to risk. Maybe I want something closer to 100% reward to risk. Okay? But the consequence of that is we're going to have a lower probability trade. But in that case, if we're gunning for this, then what we very well may do is we may go to the long vertical, long call vertical or long put vertical. The long verticals are going to be the ones that are going to emphasize that higher reward to risk. Unfortunately, lower probability, but they're also less likely to have that early assignment on that. Now, Harry mentioned in the chat, what about European style options? There is no early assignment on European style options, which is what Harry is getting at, is why he typed that in the chat. That is absolutely true. So probably less of a factor in terms of deciding long vertical or short vertical if we're using European style options. But it's not just that. Keep in mind, there's kind of three things I want to emphasize to you. Maybe more than three, but let's kind of do a quick sum up here. Then let's do a sample trade and then look at other trades here. The lessons, hopefully, we've learned so far. Number one, in terms of the difference between long verticals and short verticals, it's not a break-even difference, a max gain or max loss difference. Typically, they're going to be pretty close to one another. Okay, that's the first point. Number two, typically, we're going to, in this class, what we do is we try and keep our options out of the money to emphasize, to try and lower the chances of early assignment. Now, in paper money, they don't assign things early, okay? And to take advantage of the out of the money options, which typically will have a little bit tighter spreads, okay? So that's number two. Number three, in choosing the strike price placement in relationship to the underlying stock price, a lot of it is going to be what's your reward to risk, what's your probability there. Okay? All right. Now, Myron said, aren't index options like SPX, RTT, NDX not assigned early? That is correct, Myron. When we were talking about European style options just a couple minutes ago, that's what Harry was referring to. Everything you just mentioned are what we'd call European style options. Doesn't mean they're trading in Europe. And what it means is they cannot be assigned early. Okay, good point there. Okay, John said, in your short put example, I'd like to enter the short put on high vol days. Yes, now I have not mentioned implied volatility here on this at this point. There are other factors in there, but implied volatility certainly can be a factor. But sometimes my feeling is we can overemphasize the importance of implied volatility because, remember, let's take this first example. And I'm going to kind of clear the palette here, okay? Let's just take this first example. In the first example, the stock was roughly 197, okay? And we chose a $200 uh, let's just say short call and a 190 long call. Okay. And in the second example, stock was still 197. And we went out of the money and we chose a 190. I think I'm remembering my strike prices right. A 190 short put and a 180 long put. Okay. Now, let's think about implied volatilities here in Vegas. Is the short call going to be positive vega or negative vega? Okay. Well, a short call is negative vega. Okay. Implied volatility increases would work against us on that, but decreases would help us. The long call is positive vega. Okay. Same thing here. Short put is going to be negative vega. Long put is going to be positive vega. So does that mean these cancel each other out? Not totally, but to a large extent, they probably do, especially if the stock price is in between our strike prices. Okay. Because remember, vega is going to be highest at the money here. Okay. So if the stock gets closer to the 200, then we're probably going to have more negative vega on that. Okay. But keep in mind the vegas, it's not like a long call, just a straight long call or a straight short put, they largely cancel each other out. So implied volatilities can be a factor there, but because of this effect, they tend to cancel each other out. Now this is, we may say, oh, a short put vertical or a short call vertical is a negative vega trade. Yeah, but one reason is this. Stock price in this example, 197, is closer to that 190 put. So this is going to be a bigger effect than this, which is farther out of the money there. So it kind of emphasizes this. They still partially offset each other, but not as much as these are likely to offset each other there. Okay, all right. So there we go. Let's move forward. And while we're doing so, let me just address Terry, who asked a question. Because these are great questions you guys are asking. Hey, I appreciate your feedback. I appreciate your questions. Okay? Because you know what? A lot of times what they do is they tell me, Brent, you didn't address this. Okay? For example, Terry said, how do we know if we're going to be assigned early? I didn't mention that. Well, here's the thing. You don't know if you're going to be assigned early because it's not up to you whether you get assigned early. But the odds of getting assigned early go up if the extrinsic value goes down in the option. Lower the extrinsic value, the greater the chance of your getting assigned early. But you just never know. Now, what's going to give us a lower extrinsic value? Number one, as we get closer to expiration, the odds of getting assigned early are going to go down. Okay, excuse me. As you get closer to expiration, the odds of getting assigned early go up. Okay. Number two, the more in the money it is, probably the greater the chance of early assignment, because that's going to decrease the extrinsic value. Now, going along with that, you could say, well, something that's way out of the money is going to have a low extrinsic value as well. But that's going to, if you're out of the money, theoretically, you can still get assigned early, but it's much less likely. So in the money, your odds go up. So I don't have a rule of thumb to tell you your percentages, but in general, as Ben actually added in the chat, that's the general guideline. Less extrinsic value in the money, the odds are going to go up. Okay. Now, so let's do this trade. Let's look at this, and then I want to look at some example trades. So I have Alphabet here. I'm going to call this a bullish trade. Why? Well, I'm using some technical analysis here. I'm going to say the trend is up. I'm above a 20-day moving average. It's just kind of cruising along. above my 50-day moving average, cruising along, or past earnings. I'm not even have to deal with that. It doesn't mean we can't do it there, and maybe a little bounce here too. So we'll call that bullish. Okay. Now, remember what we said in terms of, are we going to, should we do say a long vertical? If we're bullish, our choices are long call vertical. If we're bullish and doing a vertical, I should say, long call vertical and short put vertical. Okay, those are both bullish vertical spreads here. Okay, long call vertical, we're probably, well, let me start with short put vertical. We're probably going to do both contracts out of the money, okay, to minimize that early assignment. Okay, we're probably going to do that. Secondly, so if they're out of the money on puts, we're going to put them down here below the current price. Now, in my quick example, I just picked 190, 180. Maybe we don't do that, but visually, it seems reasonable on that. These would be out of the money, but that's a higher probability trade. The stock is starting up here. And remember, all we need to do is to stay above this level right here. Okay. Now, so that's going to be a higher probability trade, but the consequence of the higher probability trade, little less good, less reward to risk doesn't look as good, put it that way. Okay. Let me go and say, what if we do this? What if we say, hey, I'm going to do a 195, 200. Stock price is largely in the middle of those. In that case, I may do a long call vertical. The short put vertical would actually put it in the money, which we're trying to avoid. This would give us a better reward to risk, but a better reward to risk. Sorry, this would give us it would give us a better reward to risk, but a lower probability. Sorry, I got confused. I got tongue-tied there. A better reward to risk, lower probability on that short call vertical, on the long call vertical as opposed to the short call vertical. All right. So the way I typically think of these is, do I want to emphasize the probability or the reward to risk? And then if I'm going to emphasize the probability, then in this class, at least what we're going to do is we're going to shoot for short put verticals or short call verticals. And if I want to emphasize the probability, the reward to risk, I'm going to do the long verticals on that. Okay? All right. So what do we want? Here's what I'm going to do. I'm going to do a short put vertical, and I'm going to say visually 190 looks good, but I'm going to look at the delta and just kind of use that as a potential guide as well. Delta tells how much the option is going to move in relationship to a $1 move in the stock price, but it can also give us a sense for probabilities. If I'm looking for somewhere maybe in the 30 to 35-ish range on our probabilities of being in the money, we don't have anything right there, we got a 29 delta, then the 29 delta may work. The 190 strike may work there. I'm going to sell this one, just going to click on it. I'm going to buy and go to a lower strike. If I go a lot lower to the 180, I have a bigger net delta. If I go to the 185, I have lower net delta. How am I getting that? Look, my delta on my short 190 is 29. If I choose the 85, my net delta is the difference between those, or 0.09. If instead I do the 180 with 13, the difference between those is 16. My delta would be a little bit higher, about 0.16. Okay. It also changes reward to risk. It changes break evens. So you can kind of play with those a little bit if you want. I can go, let's just enter the trade. Let me click on the bid price. And then let me click at the 185 shift And now I can go and confirm and send. I can look at my max profit, max loss, break even. I can also compare that. Just switch my 185 to my 180, and I can click on confirm and send, and I can compare those as well. So what I'm going to do here is I'm going to go back here, and I'm going to make this a 185. What's my max loss on this? My max theoretical loss is 385, not including commissions. And so, look, I can then decide with that how many contracts I want to do. Maybe I do 2 contracts on this. Now, somebody asked me earlier, and I forgot who it was. I apologize. Someone asked me earlier, can we, instead of looking at these as single, I think, can we look at it as vertical spreads and just click right here? If you switch it to vertical and just go to vertical, what it's going to do is it's going to put these the nearest strike price apart, which is fine. But if you want to look at something like a 190, 180, you can click on it and then adjust it, or you can go to spread, deep and wide. We're staying in the same month, 1 month here, and I'm going to go 2 strikes wide, vertical. A little bit maybe more complicated. So what I probably more often than not do, although I try and demonstrate both at times, is I just kind of click the 2 legs independently that way. But if you're trying to see the sum of these, like I was looking at the sum of the delta on those, it can be handy to go to vertical. And now what I can do is I can see the net delta on those that way by looking at them as a vertical. Okay? So good question. So yes, absolutely. Do it that way. That may save you a little time if you want to do that here. Okay, so here's the trade. I'm going to confirm and send. I'm going to just read this. This is on Alphabet. I'm going to put in short verticals. I'm going to send that order, and it failed. Okay, so now in the remaining time, what I want to do is I want to go and I want to look at some existing trades here that we have. And hopefully, though, that helps you a little bit with long verticals versus short verticals. Okay. Yeah, and so John said, yeah, John's the one who asked, so thank you, John. Appreciate that for that question. I meant to actually address your question a little bit earlier, and I forgot, but then I remembered after that. It is nice to see that reward to risk. You know, you can kind of see that way. You can't, and then to see the reward to risk, the easiest way, unless you're going to do a little bit of math in your head, is probably just to click on the confirm and send, and don't send it, but you look at the order confirmation dialog box, and it gives you that break-even price, and it gives you the max gain and max loss on that. Okay, let's go and look at some other trades. I have short verticals here. We did a trade in last week's, I think it was last week's advanced options class, an earnings trade. This is on Visa. We did an earnings iron condor on Visa. Well, Visa already came out with earnings. Let's just take a quick look at it. Here's Visa. We had earnings, and you can see what happened on earnings. Huge move on earnings or not so huge move. Not a huge move on earnings. In fact, these lines I drew in here, these blue dashed lines, were kind of the expected range of where the stock could go after earnings. Well, it kind of dipped down a little bit, bounced back up. This is a perfect scenario. This was an iron condor. This was a speculative trade on not much in the way of movement on earnings. We're past earnings now. They came out, I think, yesterday. And, we made some money, not realized yet, but the trade worked out well. After earning these specific earnings trades, usually we're going to close out. Okay, we're going to close out fairly quickly. Now, on this, let's say we were looking at this and Visa just came out this morning. Okay, what we could do is we may wait a little bit longer in the day for implied volatilities to hopefully continue to drop on us. But in this case, we had earnings. When was earnings? Hold on. I think it was yesterday morning. Am I off on that? Come on, tell me. It's blipping on me. Oh, it was yesterday, not last night. Okay. In any case, we're halfway through the day on this. So IVs would have dropped at this point anyway. So we're just going to exit this trade here. But first thing in the morning, IVs may stay up a little bit higher. So waiting a little bit longer. If you're short, if you're doing a trade where where you have a negative vega trade, you may hold on a little bit longer. So I'm going to get out of this trade. I'm going to get out one side at a time. I'm going to get out of the put side, right click, create a closing order, and I'm going to confirm and send, We'll take our profit. I'm going to do the similar thing on the call side. A lot of times it's easier to get out one side at a time rather than the whole iron condor at once. I'm going to create that closing order and move it just off the mid price a little bit to increase our chances of getting filled. And we're going to get out there. Okay. Now, do we have to get out of the whole thing? We could get out of the whole thing. Okay. We could get out of the whole thing, but the answer is that if you just leave the shorts, there's still the risk. There's still the risk there on those. Okay. If you just get out of the longs, then you're just paying to get out of the longs. So, you can do it either way on that. You can do it either way on that. Okay. Oh, can you just get out of the put side? Okay. Sorry about that. So yeah, like you could just get out of the put side. You could just get out of one side or the other. I'm going to get out of the whole thing on these. You can speculate and hold this all the way to expiration. If the stock stayed where it was going to go, say where it was, then you can say, look, I'm just going to try and let this go to expiration. But there's always the risk we get a bigger move. So usually we are going to get out. Usually for this trade, we're going to look to get out of this whole thing and just take off that risk. Okay. Let me do another iron condor. Sorry, I scrunched my screen down. We got Visa. We just added Google. That's the one we just added. Walmart. What do we have on Walmart? We got iron condor on Walmart. How are we doing? We're basically break even right now on this. When we're looking to manage these, there's good scenario, there's bad scenario. It's not like a bad scenario. We're not losing money. The stock is at 97.5. We're well above our put side. We're kind of flirting with the call side, although it's still a little bit out of the money. And normally under 10 days to go, we're just going to exit this trade. So we're probably going to look to exit this Walmart trade here on this. So what I'm going to do is I'm just going to click on this. I do have a conditional order to get out if it moves quite a bit. You can always cancel this order. You can always right click on it. You can cancel the order, and then you can do the same thing. Now, if I want to just get out of one side or the other, I can. In this case, I'm going to get out of both sides because we're under 10 days to go till expiration. And that's kind of the rules that we've used in this particular webcast. Okay. So we're going to send that there, and Walmart. We're going to get out of this side as well. Create a closing order. Buy vertical. So, and we're going to get out of that. Okay, let's look at another one here. Next one on our list. Since we're talking about verticals today, I'm kind of emphasizing verticals here a little bit, but there's another one I definitely want to look at. Apple. We've got a short call vertical. We're doing pretty well on this. We're not in a crunch to exit for time. We still have 16 days to go on this. This is a bearish trade. Are we still bearish on this, or did we turn bullish? If we turn bullish, we may just get out of this trade. So let's look at the chart. We're not anywhere near a max loss or a max gain. If the stock, we're bearish on this. If the stock breaks up, then that is a problem. We also have earnings here. Do we want to sit through earnings? The answer is we can if we want, but you know what? We've made $69 on this, unrealized at this point. I'm not sure I want to flirt with earnings on Apple. So therefore, for that reason, I'm going to look to get out of this trade. If we did not have earnings coming up, my instinct would be, in this case, would be just sit tight. Because we still have a little ways to go on this in terms of the potential profit on this. Okay, so here's what I'm going to do. I'm going to get out of this trade. I'm going to create a closing order. Now, if we didn't have earnings coming up, implied volatilities probably would be a little bit lower, and we'd probably be making a little bit more than we're already making on this. But that's what you get with earnings. So I'm going to send that trade. We're out of Apple. Now, there's one more trade I want to look at today because we do need to exit here, or we need to finish up here before too long. A trade that we did, I think, in this webcast a couple weeks ago was the wheel strategy. We were looking at AMD, and we put in a short put to try and put the stock, bring in a premium, and now there's 9 days to go. We can just let this go to expiration. More than likely, the stock went up to 178. The stock went way up on AMD. The stock went way up. Right now, the odds of getting put the stock are very slim. So what I'm inclined to do here in this case is to roll it out, but bring in more premium. We initially sold this for $400. $400. Okay. Well, right now it's worth about $11. Okay. So we've made if we let this go all that expiration, we're only going to gain $11 more. And especially since this is kind of wheel strategy, the goal is to actually put the stock at some point. So I'm going to tighten this up quite a bit. So let's look to roll this trade. What would we roll it to here? Well, I'm going to go here on AMD. Let's go out. We'll go out 16 days here. We'll go to the monthly contracts. I'm going to go to the puts. And if we go to, say, we'll go maybe to the 170, 172.50 is 37 delta. That's going to bring in about $650. So 172.50. This is August 15th. That's going to bring us in about a credit of about $650 on this, maybe a little bit less. So I'm going to roll this. Now, rolling doesn't save us commissions or anything, but it's just an easy way to change this trade. I'm going to click on this. This was the trade we were in. We're going to buy it back. This is the trade we're going to do, 15th of August. And I'm going to change this strike to 172.50. We can confirm and send this trade. This is going to get rid of the old one. It's going to get us in the new one. It's going to bring in a credit of about $640. And then we'll be prepared at some point to buy AMD. At which point, because it's wheel strategy, we're going to look to sell a call on that. Okay? So that's what we're going to do. Now, earnings is coming up. Laura put us in the chat. Absolutely. And that is no problem. We're looking to buy this stock anyway. So if earnings gives us a move down and we end up buying it, that is okay on that. So I'm going to send that order, and there we go. We got filled on this. All right, everybody. What did we do today? We talked about long verticals versus short verticals. However, if we're going for the higher probability scenario, we try and keep those short verticals out of the money. If we're doing the lower probability but a higher reward to risk ratio, often we'll defer more towards long verticals, like a long call vertical or a long put vertical. We looked at trades. We did a trade on Alphabet, a vertical spread on Alphabet. We closed out a Visa earnings, Iron Condor. We closed out both Walmart and Apple trades. We rolled an AMD trade as well. Okay? And we're out of time. Hey, thanks for joining me. Coming up next, we've got trading price patterns. And I think Kevin Horner is teaching that class, if I'm not mistaken. But anyway, thanks, Ben, for helping me on the chat. Thanks each of you for joining us today. Have a wonderful rest of the day. Bye-bye, everybody.